Hello, welcome everyone. We'll start our lesson today. Today will be our fourth session on financial management. So before starting our session today, we'll recap. Those who don't know me, my name is Anjum. I'm delivering OTHM Level 7 Diploma in Strategic Management and Leadership, and we are doing Unit 5 Financial Management. So Unit 5 have 5 learning outcome. We already covered learning outcome 1, where we already learn about uh, be able to apply the tools and the techniques of cost accounting, where I discuss with you different costing methods. We discuss about marginal cost. Marginal cost mean the cost of uh, uh, any product cost which is consist of all the variable cost, all the variable cost of production. It's come under the marginal cost. Then we discuss about the absorption cost. Absorption cost mean the full cost, the cost which is include both fixed and variable. We discuss about direct cost. Direct cost mean all direct labor and direct material or any other direct cost. Those are the part of the product which we can trace it within a product, called direct cost. So we discuss about ABC, standard costing, and different costing methods, and we discuss about the cost center, profit center, and investment center during our first lesson. So we already covered these. So we discuss about be able to apply the tools and technique of the cost accounting. And I already explained you difference between cost accounting, financial accounting, and management accounting. So managed cost accounting is a part of management accounting. So second lesson, we discuss about be able to critically analyze the financial performance of the company. So we discuss about the financial statement to assess the financial position of the company. I already mentioned you, we prepared in a business 4 types of financial statement. Statement of comprehensive, also known as the profit and loss; statement of balance sheet, which also known as a statement of financial position. We discuss about the cash flow statement. We discuss about statement of change in equity statement. So these are the 4 statements I explained you during the second lesson. Then we discuss about the financial ratios. Ratios is mean the ratios help us to measure the performance of the companies. So we discuss about 4 categories of ratios. We discuss about profitability ratios, use of resources, also known as efficiency ratios. We discuss about liquidity ratio, mean the more liquid mean the more cash position. And we discuss about the gearing ratio. Gearing ratio mean high gear, high risk. Those are the risk measurement ratios. So all we discussed during our second lesson. And we discuss about portfolio of organization, and all these we need to be look around, and I showed you few example as well. So next, during last lesson, we discuss about be able to evaluate the budget and budgetary control. So I explain you what is meant by budget. Budget is a financial plan. So a financial plan where we are, what we want to do, and within a budget. So we discuss about different types of budget. We discuss about zero-based budget. We discuss about incremental budget. We discuss about periodic budget. So these are different types of budget we discuss about. We discuss about top-down, bottom-up approach of budgeting. We discuss about the master budget. Master budget means the overall budget. We discuss about what is meant by budget and the variance. Budget figures mean what we estimate, and what is the variance, what actually we spend. So difference between budgeted and actual will be variance. So we discuss about variance can be favorable or adverse variance, and we discuss about some causes of the variance can be due to the poor estimation, or the poor, or some environmental changes happen. All these points we discussed during our last lesson. So anybody, any question, feel free, just drop me email, so I'll get back to you as soon as possible. So we'll start today our 4th lesson. So today our 4th lesson will be about be able to recommend effective long-term and short-term. So first of all, we'll discuss about long-term. What is meant by long-term? Anybody knows what is meant by long-term? Long-term mean more than a year. at least. It's no hard and fast rule, but long term mean more than a year. So long term finance is mean more than a year. Even some in a list says it's more than 3 years, more than 5 years. We cluster as a long term. Short term within a year. So sometime we need a funds. Sources of fund mean where we can raise the money from. And if your commitment can be long term, your commitment can be short term. So short term mean within a year. So we call within a year anything which is happening within a year money come and out from the business. We call this working capital. So which we'll go through and we'll discuss today more in detail when I'll do the lesson now. So short term is mean within a year and long term mean more than a year. So like a mortgage is a long term loan and a bank overdraft is a short term. So have own advantages and disadvantages. Nothing is good or bad as long as we need to identify the needs and actually requirements for the business, keeping in view of the sale forecast or the product or the services. So we need a required fund to meet the requirement of the business, keeping in view of all these things. So this will go through. Then we'll justify which source of finance you want to use it and why you want to use it. So this under learning outcome 4, which we'll discuss today. So learning outcome 4, this is inductive content. So guys, please, when you're preparing your assignment, try to be focused on the inductive contents that will help you to be address. So today we are doing sources of finance, the financial resources, type of fund, short term, long term, sources of fund internally, externally, venture capital, leverage, risk, cost, control, issues with the type of funding, technique, select appropriate source of fund, different projects, and comparison of the cost, risk, and control. So this all will go through, and a bit our discussion will be linked between learning outcome 4 and 5 because it's quite mix up. So we need to look around the working capital as well. Today I'll go through some working capital examples with you. So working capital mean the running capital is a business, is day-to-day business, and we'll go through. So sources of finance we can decide based on various factor, when time value of money, if we have, when we'll get the money, how long will payback will be. So keeping in view of all these, we can make a decision which source of finance will use. Anybody any question? So we'll go through our lesson today. Okay, so welcome everyone. We'll start our 4th lesson, Unit 5, Financial Management. My name Anjum, is my email addresses are there, so feel free if you have any question, drop me email. So today we will discuss about be able to recommend effective long-term and short-term or different sources of finance. So all this lesson will be focused on, anybody knows what is meant by sources of finance? What are the key sources of finance? How you can raise money? When you need money, we have a different sources of finance. So we'll discuss sources of finance. We can issue shares to the public. It's called equity financing. Equity finance. We can borrow money from the bank. It's called debt financing. We can sell our assets. We can get overdraft. Okay. We can discount invoices. We can offer early settlement of invoices, and we can offer prompt payment discount. So keeping in view of sources of finance. So we have to make a decision. Either we will go equity financing, debt financing, we can sell asset to raise the finance, we can use our draft, we can discount our invoices, mean the money we're supposed to receive from our customer. So those invoices we can give to the bank and we can raise some finances. Early settlement, we can say to the customer, if you pay early, we'll give you some prompt payment discount. It means early settlement discount we can offer, but it will cost to business. We always need to be very careful what cost means. So like example, if it's costing you 2%, early settlement discount you're giving and you're getting the money quicker. So you're giving 2% discount to your customer and they will pay you money quicker. But if you borrow money from the bank will charge you maybe 8-9%. So 2% prompt payment discount is better than 8-9%. So always we need to be look around these cost and benefit. We have to do cost and benefit analysis before making the final decision which source of finance we'll use. Okay, let's move. Anybody any questions? So feel free, just drop me email or ask me please in just side chat box please. So sources of finance. A business has a variety of choices it can make about how it obtains the sources the finance it needs. A business needs to assess the different types of finance based on the following criteria. So when you make a decision, you need to make a you can say you need to appraise it which source of finance you will do and which one is better for you, because sometimes your commitment long term is if you not fulfill it, it can be leads your company to be liquidation or sustainability question can be arise. So that's why we need to be look around. So amount to be amount of the money required. So first of all, don't borrow if you don't need it. So if you don't need it, don't borrow it. A large amount of money is not available through the some sources or other sources of finance may not offer enough flexibility for the smaller amount. So we need to think about amount of money required, and maybe we can use different sources of finance to raise the money. How quick the money needed? If the money is needed quickly, longer as a business spend trying to be raise the money, normally the cheaper it is. However, it may need the money very quickly. We don't have a money next week, we have to pay some salaries that we don't have an arrangement with the bank. So bank can be argue and charge you higher interest rates. So that's why early some arrangement with the bank if we are in place, so bank can give us our draft for the certain period of time so we can meet our urgent need in the following week, or we can pursue our customer, they will pay us early and ultimately or we can pursue our supplier to make them payment late and we can save that cash to use. So all this we need to ask these questions. The cheapest option available, so we need to look around. The cost of the finance is normally made in terms of the extra money that needs to be paid, secure the initial amount, and typically the cost is interest and has to be paid to be borrowed the money. The cheapest form of money to the business come from the trading profit. So anybody any question? So always you need to ask the question, amount of money required, how quickly the amount is needed, and the cheapest option available or not. So how we can do cheapest option? So information is a lifeblood for any business. So you need to make sure you get the right information at the right time, so through the right source of information. So that will help us to be find the best options on the sources of finance. So sources of finance, the amount of risk. Okay, think about if you borrow too much or you borrow heavily and you can't afford it to pay back. Are you saying no, you're pledging your asset of the company and ultimately you can't afford it to pay back and bank can? Or think about if you don't make the payment, how much damages you need to pay. Some companies at the bank will give you some flexibility, 14 days grace period. They will charge you daily for suppose £5 a day, that charge, but they won't charge you anything more than that. Maybe if you miss other banks, they will say, okay, £100 a day will charge you, £1,000 a day will charge you, depend upon the nature of the deals which we have. So we need to look around the term and conditions and the risk involved. So a project which has a less chance of leading to its profit is deemed more risky than one that does. Potential source of finance, especially external source, take into account may not lend the money to the higher risk business project unless there is short uh, some sort of guarantee that their money will be returned. So guarantee. So that's why guys, it's very to get the good source of finance with the less risk, with the less interest, always goodwill of the company. If we have a goodwill of the company is such the way we have and it's better and we make the payment always on time, that's our reputation. The credit scoring of the company, if credit scoring of the company is quite outstanding, then of course we are in a good position to negotiate with the banks. Our brand image is such a way is developed, our customer satisfaction, environment, all these factors will influence on the sources of finance as well. The length of the time of the requirement for the finance, a good entrepreneur will judge whether the finance needed is for a long term project or the short term. Therefore they decide what type of the finance. So if we have a short term, we just need a money for buy a machine for short period of time, but we are expecting money to receive from our customer end of the year, so maybe we'll go for the short term, because otherwise, anybody heard about the opportunity cost? So opportunity cost mean if you have too much finance and you have too much money and staying in your account, you're not investing, it's costing you as well, because you can multiply it, you can double it. If you're investing in one project and that money you're stuck for the longer period of time, so you are stucking is really stick project, and you can't multiply. So always do the cost and benefit analysis. So I'm going to invest in this product or project, and what cost me, what benefit I'll get it in the short run as well, medium or long run basis. We need to make sure. Anybody any question? So please ask me if any question. So next we're looking first, short-term finance is needed to cover day-to-day running of the business, and it will be paid back in the short period of time, so less risky for the lender. So if the lender will get the money after a few days, after 30 days, 40 days, and getting the interest as well. Normally short-term finance sometimes is expensive source of finance as well if you don't put the arrangement. Think about if you borrow money from the payday lender, these are the shops, and you will pay them when you will get the salary. If you borrow £50, maybe you have to pay £75, £100 back, even £50 borrow, you will have to pay £200 back. So always be careful, because when you don't have your money, you're on the you're on your negotiation skill, or you're on the sake of an other person. So we always need to be look around, manage our money. But in the business, in real world, we need to be borrow sometime, but we need to be manage good credit control. Anybody heard about the credit control? So we need to be review our credit control department. So credit control, we give only money to those people have ability to pay us back by getting the credit references, by getting their credit file and checking their history, or assessing that they have ability to pay back. And good credit control will help us to manage our finances properly. So long-term sources of finance tend to be spend a large project. Okay, so think about EDF Electricity recently set plant, atomic electricity plant, which is going to be invested by France, China, and the UK government project. So that is a quite big project. So for this project, we need a long-term finance. So these type of the project is a long term, and then in the long term they have a long term return as well, but those are the quite risky. The EDF financial director left the job, and because the CEO said is a financially, but the financial director said he's feeling is quite risky. So he said, I'm not going to take this responsibility, and he left the job. So we need to be look around the risk, more risk. So lender tends to ask for some form of insurance or the security the company. So if the government is giving the security, then it's fine. Is unable to repay the loan. A mortgage is an example of the secured long-term finance. So if you don't pay the mortgage, the bank can take your house because that's a pledge against the house. So main type of short-term finances are overdraft, supplier credit. Supplier credit, we used to be pay our supplier 90 days, so we can pay 100 days, or we can get negotiate with it, so maybe 6 months, 180 days. So always we need to be focused in the short term and the long run finances. We can divide them, short term requirement and long term requirement for the business, so betterly understand. So long term finance, the main types of the long term finance that are available for the business are mortgages, bank loan, share issue, debentures, return profit, and a hire purchase. So these are the long-term sources of finance. So bank loan can be 3 to 5 years. So think about loan. Anybody knows what is the base rate? Base rate, or we call basic interest rate, is normally set by the central bank, and in other countries is known as state bank. So they set the base rate. We have a base rate in the UK 0.75% now, and a lot of arguments last week. Central Bank of England said no, it likely can be increased 75%. So we need to look around this. If this base rate will go up, your interest will go up, and now bank loan can be, we can get bank loan around 2%. We can get a loan if we don't have a credit scoring, good credit scoring, maybe we'll get 4% on interest rate. So always we need to be very carefully, keeping in view. So maybe one bank is offering on 2, other is offering 4, other is offering 6. Are we getting the reference? So we always need to be used. This is negotiation, so we can look around all the options as well. One bank maybe will say you 6 months you don't need to make any payment. So all these sort of the option you need to be looked very closely. Okay, that's the bank loan. Share issues. What is meant by shares? Shares mean, yes, equity finance. Equity finance we can share. So according to various authors, share is more expensive source of finance. So dividend. We know dividend. Dividend means the return on our investment. Dividend. So normally dividend is more than 10% because of course you pay or not pay, but always investor expecting around 10%. Because bank giving 3, 4, 5, 6% max depend upon the base rate, but the dividend. So shares we can issue 2 types of shares. Ordinary shares. Okay, ordinary shareholder, they have ordinary shares. They have ordinary shareholder. They have a right to vote. So ordinary shareholders, they have a right to vote. So if you issue a lot of ordinary shares, whatever your registered capital with the company registrar office, so you need to think about, they can kick out the management. So you are putting yourself at risk as well, your job. They can change the management through the voting rights. So always we need to be look around share issue up to some extent. And other type of share is called preference shares. Preference shareholders normally don't have a right to vote, but it's a certain percentage you must need to pay to the preference shareholder. So the preference shareholder will get, higher return than the ordinary shareholder. So anything left we'll pay to the ordinary shareholder. So before that we need to pay to the preference shareholder. So we need to be very careful. Debenture, it's sort of the securities which we can issue to the public, and that can be have a different interest rate as well. Retain profit, so that's is a good source of finance. The profit we retain it, that profit we can reuse it, and that money, basically retain profit is the income of shareholders. Shareholder profit we are retaining it, that profit we can use it. So that can be a some hire purchase. Hire purchase. So what is meant by hire purchase? So instead of you buy a car yourself, you can hire purchase it. So on a hire it, so you pay the rent for it, or you pay the lump sum fees for it. So always we need to, whenever you make all these decisions, either short term or the long term, always look the tax and interest element. So interest is expense for a business. So when we if we are using hire purchase, or anybody heard about finance lease? Finance lease and operating lease. So finance lease, from the day first, asset is yours, like a finance mortgage, repaid mortgage. It means your house is yours the day first. If it's the interest only, you have to pay lump sum amount, and you carry on paying interest to clear your house will be yours when you pay all the off. So we need to look around the finance lease, will pay all the risk and reward if you're buying on the finance lease. If on the operating leases, you carry on paying rent, but the title of the car or the title of the property, title of the asset will stay the person who gave you lease, so or the company who gave you lease. So because there are the elements, so when we are paying operating lease, so we are saying is the rent is expense, so that we can minus from our profit, so we can decrease our profit. Decreasing our profit, we have to pay less tax, and we can save both. When we have a finance lease, we can claim the capital allowance. Capital allowance is mean the tax reduction in the first year. So maybe the first year you will save more. So always we need to look around these before making the final decision. Anybody any question? Okay, next we're looking internal and external finance. Internal finance comes from the trading of the business, and external finance comes from the individual, but don't trade directly. So internal tend to be cheapest form of the finance. Business not need to pay interest on the money. However, it may not be able to generate some of the money business is looking. So maybe we can day to day cash from the sales to the customer, the money loan from the trade supplier through the extent of the credit, reduction in the stock held. So economics order quantity we need to look around, then disposal of the spare asset or the sales, that will help us to generate. So that will help us to improve our cash flow, internal and external. So external, example of external finance, I will draw from the bank, loan from the bank, and other issuing shares. So these are the external sources of finance. Anybody any question? Okay, next our area of discussion will be so capital and revenue. So when do you decide about the sources of finance, like good debt and the bad debt? So if you're borrowing money to be study, and the student finance is a good debt, because ultimately you're learning, and then with the learning you get good job, and you have a degree, you have a knowledge, you have ability, so you can handle couple of problems, and you can progress in your life. That can be generation by generation can be benefit from it. So that's, we can treat as a capital expenditure. That's the good debt. So like you're investing money in asset, in the properties and the plant you borrow, or you buy the day-to-day things, and you're investing money, that's a revenue expenses. And the capital is improve the asset health for the long period of time, create and increase non-current assets. So that's your capital. Revenue expenses paid in respect of the purchase of expenses of the business, increase expenses in the ledger account. So revenue, like cleaning expense is the revenue expenses, carpet changing decorating your house is a capital, is a revenue expenses. It won't increase the value of the house, but if you extend your house, is a capital expenditure which increase the value of the house. So capital income is receive the sale of the non-current asset. That's the capital. You're selling the capital asset. We call non-current asset. When you're selling, that's the capital. Revenue income is your day-to-day operation receive in the respect of the sales made of the business and increase in income through the sale ledger. So that's all we're looking. So that's capital and revenue expenses. So we need to think about when you're getting the sources of finance, for what purposes you're getting the finance. So if you're getting the finance for revenue expenses, so you need to be focused on the short term, because the cleaning expenses is just, and you need to buy a cleaning machine. So try to be not go for the long term, because of course, that will cost you. Maybe in the short run, just we need it when we'll get the money and we can claim it in the profit and loss account, that we can put as expense, and we can reduce our profit, and ultimately we have to pay less taxes, corporation tax. So all we need to think and making a decision when you do. Okay, anybody any question? So next area of our discussion is the working capital. Working capital is also known as the running capital. So working capital represents the net current asset available day-to-day business operating activity, is defined as the current asset less current liabilities. Current asset means the asset which stay 1 year and carry on changing. The current liabilities mean the legal obligation which we have to settle within a 12 months. So like overdraft is a short-term tax payable, account payable. So these are all the short-term obligations. We call liabilities mean legal obligation which we have to pay. If we don't pay it, we can be penalized. So it's not really your exam, but in terms of if you have an exam question, so component are usually inventory, at the trade receivable, trade payable, at the bank overdraft. So many businesses appear the profit or the focus on the cease of the business due to the inability to meet the short-term obligation. So always we need to be focused on the short term. So working capital is very important. So in business, when we will calculate the ratios, we used to calculate the receivable days, how many days your money is you receiving from your customer. Inventory turnover days, how many days your inventory carry on changing into the finished good, you're selling it, and minus your trade payable days. So this shows the working capital cycle. So this is a working capital cycle. How long, this is working management is the center attractive of the management of the business. Current asset comprise of the majority of the total assets some companies, and the shareholder wealth is more closely related to the cash generating profit. So failure to control the working capital enhance the liquidity has been, and the major cause of the corporate can be collapse. So always we need to look around. So a lot of organizations being collapsed due to because they don't have ability to meet their short-term obligations. So ultimately, when you don't meet the short-term obligation, so your company can be at the risk. So always we need to look around when we make a decisions about you invest in the short run or the long run. So we need to be look around this very closely, and we need to monitor it. So working capital cycle is quite, so because it's working capital management in our organization, we need to be very check we are getting from the customer. We need to make sure, as we'll get the check, we'll deposit in the bank so quickly that we not really stay behind, in terms of the payment. So that will help us to improve our working capital cycle. We need to think about, we always writing to the customer, we keep the close communication with the customer. That will help us to improve our working capital. We good negotiate with the supplier. We look around different suppliers with different agreement that will help us, or we could say, okay, how much discount they are offering, keeping in view of if we'll paying early, so you will get, and you have to pay less. So your working capital cycle need to be focused as well. Okay, so next we looking the appraisal. Appraisal mean the checking the performance, which will go through further lessons as well in last lesson in learning outcome 5. So IRR is called internal rate of return. Show the rate of return at the net present value is 0. Net present value is mean the value of the money which we will get in future. So IRR must be greater than the organization cost of capital and appropriate. So appropriate is IAR can be estimate of the comparing NPV at the various uh, cost of capital. Remember that the cost of capital which give NPV is 0. So we can use this formula to calculate IAR. So it's not a numerical, but you need to look around. IAR is consist of internal rate of return, and IRR is must be greater than the organization cost. So the money you invested, so you're supposed to be get it more than its cost. So your cost of capital as the borrowing, if it's 5%, so you're supposed to get more than 5% IAR, so that you can well off, because otherwise the business is no benefit to be invest. So always, so that's why we need to look around these appraisal methods when we make a decision to borrow the money or they invest, in any project. So otherwise we are going to lose. Okay, anybody any question up to now? So please, if any question, just chat it in the chatting box and ask me, please, or drop me emails. Those are just listening this recording. So next we're looking investment appraisal, payback and NPV. So payback period. So first thing, the money you invested, you borrow money, you get a different sources of finance, you invest in the project, but it takes you ages to cover it, the money you invested. So it's quite difficult. So we need to be, when we'll make the decision either to invest money in any project, you need to make sure you always look the payback period of the project. Payback period is how long it takes to get your money back from an investment. Investment, you borrow the money and you invest it, but the payback is the longer it costs. So short payback period are generally more attractive, and you need to know what each business use as a yardstick. Easy to understand and calculate. Ignore the time value of the money. So payback period, sometime you're getting in 5 years that money, £1 now is more value the pound you have after 5 years in the real world. So that's why longer payback period is better, and the shorter payback period, shorter payback period is better. The longer payback period is very risky. And if the shorter payback period is better, the payback period help us to be measure the risk for the business as well. Okay, next we're looking the discounted cash flow is mean the value of money, the money we have now, the money we'll get in future is always depreciate. So that's why even if the £1 is the £1, but actually the £1 worth now and the £1 worth in few years will be totally different. So the things we can, maybe in the foreign exchange can be totally different, but in the real world, within a country, the value is dropped, or because that's happening as well. IAR, project with IAR is more than the cost of capital, the minimum rate of return acceptable to the investor at the worth of investing. So we need to be to calculate as well when we are making the decision, we are borrowing the money from various places, different sources of finance. So time value of money, we need to look around. The money now is more value, the money will get it. So the cost of capital and the project with the value of money, and they reject the project investment and the net present value and rank, which is a high in NPV. The project, those will give you high return. Those have a shorter period of time. So always invest in those when you borrow the money. Different sources of finance, so you need to make a decision which project, and you do the short term or the long term finance, which is you have to make the decision, and you need to calculate the cost and benefit analysis of each source of finance to make a decision. So which one? Okay, so let's quick recap. So today lesson, all we learn about different sources of finance, short term, long term. We discuss about working capital cycle. We discuss about working capital management, and I explain you investment appraisal, how we can, and on what basis we can decide what source of finance is fit. So short term is mean within a year, and the long term source of finance which is mean the more than a year. So be able to recommend effective long term and the short term. So I gave you some. So you need to look around the interest rate, you need to look around the time factor, you need to look around the risk, you need to look around the control, you need to look around some legal requirement, you need to focus on the taxes, you need to look around which project are the which investment purposes you borrow the money. So on the basis of these you can make the decision which source of finance you will use and which one. Either equity financing. If you use equity financing, it means you're losing your control because the shareholder have a right to, and normally according to the various authors and various theories, the equity financing normally is more expensive than the debt financing because the shareholder expecting more return than the on the debt, which is a fixed rate of interest normally you pay. So all this we cover. If anybody have any question, feel free, just give me drop me email on my email address, which is this, and I will do last lesson on unit 5 financial management next week, uh, on Saturday between 11:30 till 12:30. So if you have any question, so in the meanwhile, feel free, drop me email. I'll get back to you. And thanks for listening and thanks for attending this session and have a wonderful time. Bye bye.